Hi folks, recently I had met somebody who had come from abroad and he had money that he wanted to put away for a short time. So nothing which was linked to markets. And we were discussing whether it makes sense to put money into Indian debt funds. So I went on to do some checking and this is what I found. I thought I'd present it here. I've never been an NRI, so I don't have practical experience in investing in products like FCNR deposits. So I'd be happy to hear your thoughts and inputs. So I'll share my screen here. Since the friend I was talking to was from Malaysia, so I've taken Malaysia as the country where the NRI is residing to compare with the other products. So now, if you look at the flow of money, as in how does it get invested, how does it get converted, then we can see that the money that is invested in the deposit product, which acts like a local FD, is the Malaysian ringgit only. It gets invested, there's no conversion, it comes out as a ringgit. The FCNR deposit, now I can choose the kind of currency that it has to be held in. So I take my ringgits, I convert it into USD, it gets invested, and then after 1 year, when I take the money out, I convert it back into ringgits. The Indian debt funds gets converted into INR from ringgit at the time of investing, and when I withdraw, again the conversion happens back. Now this is important to understand because the role of conversion and the currency rate movement plays an impact here. Now for the purpose of this discussion, I've assumed that we are putting 5,000 Malaysian ringgits there. The rate of conversion a year back was 1 USD was a little over 4 Malaysian ringgits and 1 ringgit was a little over 20 INR. So by virtue of this, the time frame that I'm assuming here is also 1 year. Let's see the impact now. So when I put 5,000 Malaysian ringgits, when it gets converted, it is as if I am investing the amount of 1,200 USD into the FCNR deposit or 1,01,000 into INR. Now, the expected rate of return which I have here is the current rate of return. So, I'm taking the current rate of return here, which is 3.5% is expected from the deposit product in Malaysia. In the FCNR deposit, I'm expecting 4% return, and in the Indian debt fund, I'm expecting 7% return. Now, on the face of it, it looks like it's a no-brainer. I should invest in the Indian debt fund because I'm getting the maximum return here. In fact, I'm getting double of what I could invest if I'm an NRI in Malaysia and I put it in the F product there only. But let's see what the impact of conversion has on this. So when I apply these rates to the initial investment, so 1,213 USD becomes 1,261 USD and 7% return on 1,01,000 translates to 1,08,000. Again, what are the current conversion rates currently after 1 year? The USD has strengthened against the ringgit. So the USD is now worth 4.2 ringgits from the original 4.121. Similarly, the Malaysian ringgit has strengthened against the INR. So the INR, now for 1 Malaysian ringgit, I have to shell out 20.978 INR. Now, what is the final value that I'm getting? 5,175 Malaysian ringgit in the first product because I put 5,000, I applied 3.5% return and I got 5,175. Therefore, my net gain was also 175 rupees. This is as expected. Whereas in the FCNR product, now my net gain is 306, which on 4% return should have been 5,200 and my gain should have been only 200. Similarly, my gain has got affected in the Indian debt fund. What is the net return that I'm getting finally is my expectation was 3.5% and my return was also 3.5% in the deposit product because there is no fluctuation here, it is stable. In the FCNR product, I was expecting 4% return, but I've got a surprisingly higher return of 6.12%. And in the Indian debt fund, where I was expecting the highest return, that has unfortunately given me the lowest return. Now, this is not to say that it is wise to invest in FCNR deposits and not wise to invest in Indian debt funds. This is to show you the stability of the local deposit products vis-a-vis currency related products. So if you're able to stomach volatility, if you're okay with the losses which are coming due to currency movement, but you also are excited by the upside, then you can look at these products. Otherwise, it is safer to invest in the local product. So what happens if there was a reverse movement, for example? Let's look at the impact here. So here I plotted the currency movement for the three currencies that we spoke about. So as you may be aware, the Indian rupee has depreciated against the USD for a long time. The current rate of depreciation is 3.71% over a 5-year period. If you look at the annualized depreciation, it is 3.71%. Similarly, the INR has depreciated against the Malaysian ringgit as well, similar 3.4%. And the USD and Malaysian ringgit have sort of remained stable in the last 5 years. However, you can see that there has been movements in between as well. So now, as I mentioned earlier, and you can look at these two fields here to see where the impact is coming. So if the Malaysian rupee had depreciated against the Indian rupee, let's say that these two numbers got reversed. Then you can see that the Indian debt fund would have returned 10% plus. And if the change here was reversed, that is the USD depreciated against, then you would have got only 1.92%. This is very important to understand, because when we look at these look like small movements, but they can have a big impact on a rate. And if you and me are not qualified to predict currency movements and also don't have the ability to stomach volatility, then we are better off investing in local debt products. So I hope this video helps you in your investing journey. If you have any queries, inputs, comments, please do drop it and we'll be happy to get back to you. Thanks for watching.